What if one simple change to Bitcoin could increase its value by 750%? And what if the most important upgrade to Bitcoin in 2025 wasn't its code, but was actually from accountants? Well, that's the case for Bitcoin and many other digital assets in 2024 and 25. FASB's new fair value accounting rules for GAAP reporting companies have just rewritten the playbook for Bitcoin and digital assets in corporate finance. This new rule means companies like MicroStrategy, Coinbase, or your company holding Bitcoin on the balance sheet must recognize the appreciation on their Bitcoin. In the case of Coinbase, increasing the reported value of Bitcoin on their balance sheet by 750%, from 117 million to 900 million by today's prices. And that's according to BitcoinTreasuries.net. The new fair value rule isn't just a win for transparency, it's a green light for corporations and banks and other TradFi institutions to seriously consider crypto on the balance sheet. On today's episode, we break down the new FASB rules, what you need to do to take advantage of these new rules for your company, and how to stay GAAP compliant. Welcome to TNF Takes, the go-to spot for crypto companies and on-chain organizations. Before we dive in, make sure you like and subscribe to continue getting top-tier content for your crypto company or on-chain organization from industry experts who've been around the block. I'm Noah Buxton. I'm here with Jeremy Now and Nick Ward from the network firm. We're here to help you establish trust, build efficient crypto operations, and stay ahead of the curve in an ever-evolving industry. Gentlemen, good morning.
Morning, guys.
Nick, Noah, good to see you again.
How much crypto are you guys selling here? It's the 29th of December, coming up on the 31st, New Year's Eve. Are you guys harvesting losses? What's the deal?
Well, this year is actually a good year. Not harvesting too many losses because there haven't been that many. But am cleaning up my wallet hygiene, getting ready for the new IRS rules, consolidating wallets, doing that whole thing. Still some year-end activities to do.
Love to hear it. So I think we can know by that statement alone, Jeremy hasn't been too involved in the meme coin.
That is true. You caught me.
All right. Awesome, guys. Well, let's get into it. Yeah, I think, again, today we're talking about fair value accounting rules promulgated by the FASB, the Financial Accounting Standards Board, right, which issues GAAP, generally accepted accounting principles, for public companies and private companies. And so maybe we just set the stage of kind of how we got here, right? And the thing we're talking about is this ASU 8. Maybe Nick, you can kick us off. Give us the lay of the land.
Yeah, so this was big news a few years ago when they actually announced it. And yes, a few years is correct, where they announce these things and then it takes a while to roll into effect. But prior to this, there was no specific guidance from GAAP or FASB on digital asset treatment. So that left us with, you record it at cost, and then you assess for impairment, which essentially means you bought your Bitcoin at 100K and then it dips to 97. Well, now you've got to mark it down, and then it's back to 100K, but you don't get to mark it up, and that's how you carry it until you liquidate it or pay for services with it, right? And so prior to this, there was nothing. So a lot of industry advocates or just folks, digital asset companies were writing to FASB to urge them to take on this issue, to basically put some rules out there, because not only does that treatment look wonky on their balance sheet, but with no rules comes a lot of inconsistency, a lot of questions and calls to firms like us about what do we even do, and they get different opinions. So it's just messy. So it was great that they finally did create a standard, and that standard allows for fair market value for certain digital assets that they defined within it, which we'll talk about in a bit. And also required some disclosures, which will give, I think, better information to users of financial. And again, cut out the debate between companies and their CPAs who maybe thought they should put more in their disclosures versus less. And with no rules to point to, it really is just a judgment call by those parties.
Yeah, Nick, I think what a lot of people had a problem with is classifying digital assets as intangible assets, right? I feel like it was just kind of a home to place digital assets because nothing else made sense. But I always thought it was interesting, okay, well, why was it an intangible asset in the first place? Because that is what made you have to effectively assess for impairment and write it down to cost, right? So I know it wasn't cash, right? They're like, okay, you can't value it as cash or have it as cash in the balance sheet because it's not legal tender. And what I thought was ironic is that actually it became legal tender in El Salvador, but then they changed the rules and said, well, it has to be a widely recognized legal tender. It couldn't just be in one country, which was interesting. But long story short, couldn't be classified as cash. It wasn't, a security, right, or a stock because it wasn't an equity instrument. It wasn't inventory because it usually wasn't, for most companies, if they're holding it for sale, it wouldn't be classified as inventory. So it was kind of this place where it's like, all right, it's nothing else and it lacks physical substance. So let's just call it this intangible asset. And I think that's what we kind of got stuck with. So I'm really glad they finally addressed this and kind of created its own classification.
Yeah, no, I mean, it's interesting because it sort of makes sense that it gets in that bucket, and it still is part considered an intangible asset, right? It now just gets that fair market value treatment. And so I think I'm with you, though, that to put it in there, it doesn't have a life, right, where it would depreciate to uselessness or something. It made a little sense like software, but to not allow for the like people are paying with it, things like that, it was absurd. And I'm sure many auditors out there have nightmares of thinking back to having to test for impairment. If you did a lot of that work, we did a lot of work with miners over the years, right? So Bitcoin miners are constantly stacking Bitcoin, and to go at year end and explain to clients, hey, you had to impair this down to the lowest price during the period when you held it, getting those stairs, and then realizing, you had to track it by lot in that way and have to audit that was just a mess and help anyone.
And maybe one other piece of context of how we got here too is we've been talking to companies for years about, it makes a lot of sense, right, that you'd be able to classify this asset and be able to market to fair value at sort of end of accounting periods, right? That makes a lot of sense. And you'd have some unrealized gain or loss that would pass through the P&L or through the income statement. It makes logical sense, right? But when FASB looks at these things, they look at a number of factors, but one of the biggest ones is the pervasiveness of the issue. And so, 3-4 years ago, FASB's looking across the market. How many public companies were there that actually had Bitcoin on the balance sheet or other digital assets significantly on the balance sheet to where, the reporting of those companies wasn't, on its face reflecting the economic reality of the balance sheet. And that's kind of the other piece here is the economic reality of the company's balance sheet. So probably other factors as well, like fair market value, even years ago, being able to get a very accurate price from a principal market for Bitcoin. And so I think all of those things have matured. We have more public companies now. We have disparity between public company reporting. So there's sufficiently pervasive. There's also some disparity of mismatch in reporting. So it's hard to compare apples to apples. And we also have more mature markets, right, where you can have more principal markets to actually get a reliable fair value measurement. So
I was going to say, the last thing to say is that intangible asset, it makes sense, right, to make this change because it became pervasive enough public companies, and effectively just they had enough time to get to it. But that intangible classification was really initially meant for patents, trademarks, copyrights, goodwill. So that's what we're talking about, why digital assets really was in substance pretty different from these. So I think that's what prompted this too, is that it was getting bucketed with those types of items, which really didn't make sense.
It was the square peg in the round hole, and we just had to pound it in there, basically.
Yeah.
Okay. All right. So maybe I think you guys kind of touched on the key provisions. I think we hit a couple of them, but for this ASU 2023-08, there's obviously some definitional importance here, sort of who's in, who's out, what assets are in and what assets are out. Can we clarify that?
Yeah. So who does this ASU apply to? Which assets can you use this treatment for? It's not all crypto native or digital assets. It's only certain assets. So there's 6 criteria outlined by the FASB. So it needs to meet the definition of an intangible asset. Right. So that's the first one. It does not provide the asset holder with enforceable rights or claims on an underlying good, service, or other asset. So what does that mean? That means tokenized assets, for the most part, aren't included, right? If you have a tokenized piece of real estate that's you can redeem for underlying real estate, or tokenized, even stable coins here are kind of still a gray area, in my opinion, because that gives you a right to claim the underlying. Fiat backed do, but let's say DAI might not, right? You might get another crypto. So it could get a little confusing still. No or enforceable rights to claim on an underlying. They need to reside on a distributed ledger or a blockchain. It doesn't say how many nodes, how public, how private they need to be, but we'll lay that aside. They're secured through cryptography. They are fungible. So that means NFTs or non-fungible, out of scope here. Semi-fungible, kind of fungible, still maybe a gray area as well to consider. And they can't be created or issued by the reporting entity. So if your company was the one who actually issued the token, you can't use this treatment. So if you're XRP, for example, or Ripple, right, and you issue XRP, this going to be still a gray area for you to consider, right? How do I treat that XRP that I'm holding in Treasury, almost like Treasury stock, on my balance sheet? It's still open, or it's not clarified through this ASU. So I think that's the universe of things, which I find pretty interesting, but a lot of them make sense, but there's still some gray areas that I think will be open for judgment and determinations by reporting entities and accountants.
Awesome. So there's some of the asset, criteria sort of in and out. What about types of companies? I mean, is this only public companies, like we've mentioned, MicroStrategy and Coinbase, maybe other public miners, or private companies as well? Who's this apply?
Yeah, it applies to both. So this is now GAAP, right? So when we talk about US GAAP standards, anyone issuing under those will have to adopt for any financial after December 15th, 24.
So that means like December 31st, audited financials as of December 31st, 2024, they effectively will have need to adopt this standard. If they were some reason had, they're reporting as of November 30th for whatever reason, they could still, not early adopt, not apply these standards. So that's that cutoff time, really affecting these financials that are going to be issued probably in, Q1 of this year as of 12/31/2024.
Yeah, I think you just mentioned like a company audited as of 12/31. So like their fiscal year is 12/31. But just to be clear, right, like as Nick said, this is GAAP, right? So you could have your financial statements audited sort of for compliance with, or the criteria of that audit being GAAP reporting. But it's not necessarily companies that are audited either, right? So this is privates and publics. I think there was an early adoption period, right, where some folks could have adopted this early in 24 if they wanted to. It was elective, but now sort of going into 25 roughly, most companies are on that 12/31 fiscal year end largely, right? So it's basically everybody, every US company with qualifying digital assets on the balance sheet. Is that a fair way to say it?
Yep. Yeah. Essentially, Go ahead.
Yeah. Oh, sorry, I didn't mean to cut you off. I'm interested because there's we serve a number of token projects, I guess is kind of how they're referred to, right? But they're a collection of, or a group of entities, maybe sister entities, whatever. There's a corporate structure basically that allows for the tokens to be managed offshore by a nonprofit foundation. I think that's an interesting one because like Cayman and BVI, like Cayman, I think is pretty elective unless you're like an insurance company, a few other specific ones, but you can report under IFRS or GAAP. And so I think there's actually an outside the US impact here too. A number of different jurisdictions, right, essentially apply GAAP or apply their sort of version of GAAP, right? Like Japan has Japanese GAAP basically. So
yeah, that's interesting. I don't know the exact impacts of, like, if Japanese GAAP, for example, would feed off this and adopt part of it or not. Obviously, IFRS has been a little bit better, frankly, than GAAP these past years because they've had a better window to apply fair market value, right? Where they do, if you're using ETH because you have gas, you could consider it inventory. Under IFRS, you can create financial asset buckets for most crypto that allowed fair market value already. But it's a good point. Yeah, does someone who's on the edge now maybe consider GAAP reporting or just have an easier path to it? I'd argue probably yes.
Yeah. And part of the US economy is like the financial markets are the most mature in the world. And part of that though is like the accounting rules. And that's why GAAP has been applied to these US companies and they've kind of impacted or spread throughout the world as these multinational corporations. So part of that is GAAP has kind of pervaded the world too, and it's just kind of whole part of that financial apparatus that the world operates under.
Yeah, maybe real quick before we get to the accounting treatments, I know that we've worked on this issue for years. Like we've talked to clients about it. We've worked with clients sort of in the weeds about this issue and how to deal with indefinite lived intangibles and impairment treatments and how that flows through the financials. We actually, had the pleasure of working with the Digital Chamber as well. So long-term members at the Digital Chamber, and I got to work on policy advocacy there. I know you guys helped quite a bit with, sort of making the case to the FASB around fair value. And I think it's an interesting time, just so folks know, like from, sort of the inside baseball. So the CFOs types listening, CFOs and controllers, if you're an IFRS reporting company, like Nick mentioned there, it's kind of on the front end a bit easier because IFRS, is it IFRS 9? I'm going to go stick my foot in my mouth, but I think it's 9 basically like already sort of had this fair value. You could find a better bucket for Bitcoin and other like digital assets, but the way it flows through the financials is through other comprehensive income as opposed to through unrecognized gain or loss in the P&L statement under GAAP. And so that's where the OCI becomes sort of a secondary problem, where is that OCI reflecting the economic reality as well? So you kind of have the same problem. It's just sort of at the second phase of it. And so I'm interested to meet some more people at the IASB and talk about IFRS, because I think there's reporting companies out there in the UK that need a similar, like there's these treatments need to kind of align, right? And we've got these multinational companies now, exchanges, and some of the largest providers they operate across many jurisdictions and have consolidated financials and the whole thing. All right, just a little inside baseball stuff there for you. Maybe let's do some debits and credits. Let's talk about like the accounting treatments, maybe step by step. Just make it real clear.
Yeah, I think we've been teasing it for the most part, right? Fair market. We keep talking about marking it up to fair market values. You're still going to you're still going to record your digital assets at cost when you acquire them, which again, cost is the fair market value at that time when you're making the initial purchase. But now you've got the opportunity it's now the 6 months later or a quarter later, and you're going to do some quarterly filings or reports. You can take the fair market value of that at that date and mark it up or down still to what that fair market value is. And so you'll have an unrealized gain or loss on your P&L, and you'll mark the asset on the balance sheet accordingly. There really isn't any more impairment testing because, again, if it goes down, you'll still mark it down, but you can take it back up. That's really the accounting side of it. Jeremy,
Yeah, I was going to say that's the big thing. Like the biggest annoyance for our clients is that you still have to track each lot of your Bitcoin, right? Because you need to know your initial cost basis on your balance sheet. But it was individually testing each lot for impairment because you acquired them at different dates. That you'd have to take, okay, what date did I acquire this? And what was the lowest price where this lot was, in existence, and compare that. And you had a different population of lots or daily prices that you would have to compare each lot to. And it was just such a pain in the butt. So this just really makes it easier. You'll still need like a crypto accounting subledger to track your cost basis, your gains or losses, but you're just not going to have to do this impairment testing that was, I think, the bane of many miners and other crypto companies' existence to track to assess every lot like that. So that's the biggest impact for me, guys, as we're thinking about, okay, the biggest impact for our clients, like that's huge. It's going to save a lot of costs.
Okay, so it makes it quite a bit more clear with respect to that, and we need to move forward. But like just to talk about one of the pain points again, and that's being relieved here. The other issue was like how frequently is your remeasurement period, right?
Yeah.
And there was such a disparity like over the years of how people would treat this. The way I read GAAP basically said, right, like you're looking for a significant indicator of impairment or an indicator of impairment, right? It's got to be significant, right? And then that's based on, well, the nature of the asset and the volatility of the asset, and you're looking to your principal market for that indicator. And we had like literally spanned, we had firms that were saying, oh, no, this is like you need to do impairment on a daily basis.
Or hourly, even like the low for the day. Yeah.
Yeah. Yes, exactly. And which price to take was the other thing. And then, we had, I think our approach was largely more reasonable, right? To document it up and say, look, it's at the end of an accounting period, right? And I think that's probably right. I mean, sure, you can impair up and down, or you can't go up and down. You can impair or do this testing on a micro basis, but ultimately it's about the economic reality, true reflection, transparent reflection of the financials at the end of a financial reporting period. So at the most frequent we got to was a monthly, right? Well, actually, I think we probably had a couple that.
It depends if
Yeah.
you're public companies too, because they're much more stringent, right?
Yes. Yeah.
And you need to report sooner, right? That you're going to have a quarterly filing as a public company. It's like, to your point, no, I mean, I think we did always recommend monthly just to avoid the large exercise at the end of the quarter. But yeah, I mean, it really came down to when did you have to report. And then even for private, where it was annual reporting, we'd still recommend maybe not monthly, but quarterly, just because, especially for the miners, if they weren't liquidating or they knew they were keeping some of the stack, it's like, it's such a pain in the butt exercise to do at the end of the year to look back, right? Looking for prices. So we're like, just for your own sanity, it's probably better to do it a little more frequently and avoid that big to do at the end of the year.
Okay, so then moving forward, though, I still have the same question. Actually, when's the fair value remeasurement period? Is this on a monthly close? Certainly for a public company, right? It would seem like the unaudited quarterly financials would include this remeasurement.
Yeah, again, I think it's the same kind of answer of just when do you have to report, and then how much do you want to have to look at it. It's funny because, like, for internal reporting, right, you think about MicroStrategy, they know they've got the Bitcoin in the treasury, they know how much. When they're doing a monthly close and the management team's reviewing those monthlies, does that really impact their decision making and plans in terms of spend and capital investments, everything? It's like, my gut would be probably not, because they're aware, they know what Bitcoin is, they know it's going to be volatile. So, pending any large significant change in the network or something beyond that, is it really impacting decision making? And so from that standpoint, you could probably argue we just need to do it quarterly when we have to report because it's required for standards.
Yep. Yeah,
But,
and that point you raised around, okay, is that we're comfortable with Bitcoin, we understand its volatility or whatever, we understand our entry price or our average cost basis across every acquisition. That kind of goes to the Bitcoin treasury, sort of corporate treasury policy and approach as well, which I'm not sure we'll go deep on today, but we probably should do a whole nother episode on, because there's a lot to that.
Yeah.
Okay. Good stuff, guys. Go ahead, Nick.
I think, I was going to say, I guess one alternative is if you have outside investors, or maybe a management team that, yes, they're aware you've got crypto on your balance sheet, but they do want to keep a closer eye, right? To your point of, depending on what the policies are, there may be a closer, tighter internal kind of controller level set, right? Working capital or some other that would trigger maybe a reconsideration of that. So then they will want to see fair market value. So I guess the closing pin on that is just, it depends on each company's internal situation, what they want to be tracking or not. And so that can dictate, how frequent the updates are happening outside of just the required reporting periods.
Yeah, that's a good barometer, though. Like, if you're sending financials to investors, that brings in the need to be transparent, accurate reflections and disclosure. And so I think that's probably a good baseline to get in. And now it's easy as compared to impairment too, right? So not a huge burden on the accounting team to do this. Okay, I think I understand. I think I got who assets are in and out, what the basic accounting treatment is on the balance sheet. What about, just real quick, tell me about the P&L aspect. I mentioned sort of how this flows, but let's talk about at the end of a quarter, let's say, and it's the first remeasurement on fair value. Give me sort of Bitcoin goes up or Bitcoin goes down. How does this impact the other financial statements?
Well, the key things to consider is that we talked about the balance sheet. It's going to be on the balance sheet as of your new fair market value, right? And you'll have the gain loss on your income statement, but there's actually going to be new disclosures required for the readers of the financials, which are new. Maybe people were including these before, but now they're prescribed. So the first disclosure will be effectively a statement of digital assets that's been popularized, which would have basically your list of each crypto that's material, the units, the cost basis per digital asset, and then the fair market fair market value as of the end of the reporting period. And then you'll total them so you can see your total cost basis versus your total fair value. And that should equal the gain loss on your income statement, right? That difference. So that's the first note. that you'll include. There's another one that's a little bit more complicated. It's essentially a reconciliation or a roll forward of the company's fair value. So it's going to be a roll forward where you'll start with your beginning balance as of the previous reporting period. So if you're doing your annual financials, it would be the end of last period, right? The fair market value, your additions of digital assets, your disposals of digital assets, and then your unrealized gains and losses. That should equal your ending fair value balance on your balance sheet as of the end of this reporting period. So that can actually get a little bit complicated because when you're doing your additions and disposals, you'll have gains and losses on those as well. So you'll need to make sure that you're tracking that appropriately. But this is helpful for investors, right, to understand how much Bitcoin did you do, or how much digital assets do you buy and acquire, and what were your unrealized gains and losses on those assets during the year. So you're still going to actually have a good amount tracking and cost basis tracking.
Okay. Yeah. Super helpful. I think I get it. I'm thinking about that disclosure. So disclosures can be line items. They can be numbers, counts, schedules, tables. They can also take the form of like verbiage too, right? They can be a note. So how do you guys imagine this? Is it kind of fact dependent? Like depends on the company, but like you mentioned, this statement of digital assets. I could kind of imagine that being a written out statement like, hey, we raised 42 billion in bonds and we bought whatever, using the MicroStrategy example, we bought this and we sold nothing, and our average cost basis across all of them is this. There you go. But then that roll forward you mentioned, is that something companies need to have? It's a financial statement that's produced and shared, or is that like what you would think of as like a month end close, like a schedule that's used in a process, in the accounting process?
Yeah, I know, Nick, like when we're drafting financial statement notes, right, they can take different forms and it'll depend on the information. So like, let's say you had a huge list of digital assets with cost basis and like changes in fair market value. The easiest way to present that's probably in a table. But like if you just had Bitcoin, right, and you didn't have that much activity and you can just say it in a sentence or two, like maybe that's the easiest way to present it as well. I think there's flexibility. It's not prescriptive of specifically like how you're going to present the information, but it just needs to be there in the notes. I think for the roll forward, it's probably easiest to do a table versus kind of writing out a reconciliation or a roll forward. But for when you're disclosing the digital assets, I think there's a little bit more flexibility, especially companies that like are just holding Bitcoin in their treasury, right? You're not going to have as many line items. So, you could consider, writing it out in words versus a table in that instance, in my opinion.
Yeah, agreed. I mean, both, you're going to have a mix of both, and depending on what tells the best story to the user, and when I say best, I mean gives them the information they need, that's where you're going to end up. And so to Jeremy's point, someone that's dealing with a lot of different crypto assets and they're trading or just moving in and out a lot, that table reconciliation is going to be probably the best to give the full picture. But again, there's still going to be some verbiage leading into that, and certainly verbiage over the accounting policies. All of that's earlier in the disclosures. And then this does kind of raise, Noah, to your point of like, is this just something internally they need to be doing? It's no, this will go in the disclosures, but with anything in the disclosures, you should have an internal process to make sure that, you're tracking it during the year, you have the information you need, and come audit time, if you do get audited, you've got support for the auditors to beat up versus, them having to either book adjustments to get to that point or push you to do a schedule you hadn't done yet. So again, it comes back to, hey, yes, you could do these things quarterly, but with most, especially the more activity you have, usually the sooner is the better, because you'll just have less time to have to be reconciling and you'll have a good schedule throughout the year.
You basically should just consider it as part of your financial reporting requirements, right? Even though they're in disclosures that sometimes people overlook them, like you need to report on them. Include that like in your month-end close process and all that stuff. What's unique too, I didn't actually catch this the first time I read the new ASU, but it doesn't prescribe a specific cost basis method. So it says that you can actually use different cost basis methodologies like first in, first out, spec ID, specific ID, average cost, or other methods. Now, it might be annoying if you have a different cost basis tracking method when you do taxes versus maybe your accounting treatment. Might be another tax to accounting change that you'd have to track. But I did find that interesting, and haven't thought through the full impacts of that, but something to know for our listeners.
That's a good one.
Yeah, yeah, for sure. I mean, at the corporate level, right? Just sort of not being a difference between sort of ordinary income versus capital gain income, right? It's a little less urgent, but yeah, I agree. Yeah, this has always been the difference between tax book and accounting book, and here it is again. So I think we can probably put a bow on this one. I just want to make sure we cover a couple more things before we go out. So, like, first off, is there anything I didn't ask that's sort of like key things that are changes? One of them I think is probably obvious is sort of a change to the chart of accounts here, right? There might be a change to P&L accounts. You might have a realized gain or loss for any dispositions, right? But this unrealized account becomes pretty important or necessary, really, as you're remeasuring at the end of a period. First off, is there anything else? And then maybe we can talk about sort of what we think the larger impact of this is, right? I gave a pretty lofty statement at the beginning, right? This is Bitcoin's biggest upgrade in 2025. Not financial advice necessarily here, but like just discussing, sort of the pros and cons. Is there anything else that I missed?
Nick, I always wondered actually, like, what do companies need to think about, like, during the transition, right? Because, like, let's say they're a public company and they have multi-year financials that they have to disclose. Like, does this mean they have to go back and restate their previous years with this new treatment for that comparability, or is it kind of on a go-forward basis, or does it depend, right, on who you are?
Yeah, it's a good question actually. I think it depends because again, if you go read the last quarter of financials from some of these public companies, they're calling out that a new standard is coming, what the impact will be, not necessarily quantifying it, but just that hey, we'll have to mark to fair value. So they've given their readers that update that it's coming, and so now when they implement it, I don't think they have to go back and restate by any means. It'll just be a note of hey, this is the change now. If it is a comparable statement, they likely will in that disclosure call out that, if this was last year, here's the quick 2 changes to these accounts within the notes, but not a full restatement would be required.
And what if there was like an adjustment to, like, do you need to adjust your beginning balance for the period? Like, because I've seen in some other changes, right? You can either restate, do the whole thing over, or you can like have one adjustment that quantifies the adjustment for the beginning balance. Do you think that would be the case here, or?
Again, I think it'll depend on the scenario, but in that example I laid out of, if you were going to call out the change to the prior period, it would be, hey, this is change to the asset, right? The P&L, which would have, impacted beginning equity.
Gotcha. Okay. Yeah, that makes sense.
Yeah. So some companies could see like potentially a huge jump in their first month or first quarter of reporting in 25. Let's say they were long holders, Bitcoin treasury, right? They could see a huge income jump on the P&L. Is that right?
Exactly. You're going to have this giant unrealized gain. I mean, we could talk about the elephant, right, of MicroStrategy. They did not early adopt. So this Q1 25, or well, their 12/31 actually, financial statement will now have this adjustment. So it's something I'm like very interested to watch happen, because I think anyone who pays attention to Bitcoin, even if you're not paying attention to accounting, Michael Saylor's been talking about this, right? He actually was right along with us in the digital chamber and advocating the FASB for this change. So he's been talking about it a long time, but I still think, the general market is going to wake up to these headlines of, MicroStrategy has this giant gain for the year due to Bitcoin holdings, and not realize that, you could have been doing this math and expecting it all along.
Right. And it's like if you're measuring apples to apples again, it's sort of like you're looking at PE ratios, for instance, across companies. Like, I don't know what MicroStrategy's PE ratio is right now, but it's going to change significantly, right? This isn't taxable income, right? Like you said, it's unrealized in this case of MicroStrategy, but I think it's going to change their PE ratio. I feel like basically the first couple of periods in like you said, end of 24 and into 25 are going to be kind of like these outliers, like, okay, everyone's catching up basically. All the big gains are sort of flowing through these P&Ls unrealized, and then, things will settle out. I'm not sure how you guys see it.
I mean, just to quantify it a little bit, MicroStrategy's market cap is 80 million or like 81 million as of time of recording.
billion, yeah.
80 billion, sorry, 80 billion. But their unrealized gain on their Bitcoin holdings is 15 billion that they're holding, right? So it's pretty significant. Their total value of their Bitcoin holdings is 42 billion. So it's almost half the market cap of the company. So like any change in the Bitcoin valuation is going to have a huge impact on the financials for this company.
Absolutely.
Yeah.
I think we could continue to go down that rabbit hole and talk about, is it priced in for MicroStrategy or not? But in any case, let's divert away from the rabbit hole. And any other topics you guys think that I missed or didn't ask you about for how to, how companies, CFOs, controllers can prepare here? And then let's talk about, so what's the larger impact that we think this is going to have?
Yeah, I think we covered really most of the direct impacts, right, to the statements. And I just would reiterate, get a process together if you haven't already, to make sure you're tracking, you have reconciliations, both USD and in the units of the digital assets. If it's just Bitcoin, it's going to be a little simpler. But if you have a number of different crypto you're dealing with or on your balance sheet, that reconciliation is going to be a bigger pain than you would anticipate. So making sure you have a process to do that monthly or just on some cadence so that you've got an internal routine going is going to be big.
Yeah, 100%. That's the big thing for me and for companies to prepare. Just get those disclosure schedules ready, and any maybe adjacent or ancillary policies that might be tweaked at your company, update those for these changes too.
Awesome. So then what's the wider impact? Does this accounting change, is this really Bitcoin's biggest upgrade in 2025? Does it change a corporate's potential interest in putting Bitcoin on the balance sheet? Let's say they're not a core crypto business, right? They don't have this stuff flowing through the financials already. Does this make sense as a treasury strategy? Does it make more sense now? Or does it still have to make sense on its own merit? And then this is just like the accounting piece of it that's a little bit fixed up, so it makes it easier if they agree on the strategy. How do you guys see this?
My opinion is, like, think if you're a decision maker at the company and you have a treasury and you have different assets that you can choose from, and you're assessed or you're evaluated on a quarterly or an annual basis, and you have one asset where you can recognize the gains and one asset where you can't, right? The asset might 10x, but you can't show that to your investors, right? It doesn't show up on your bottom line. Like, you might be able to disclose that in a note or something, but it's not shown to the bottom line. Are you going to choose that if you're a pension fund, if you're a corporate, if you're an endowment, where you have this short-term time horizon where you're judged? Like, I think it does matter. I think it is going to make a difference. It's just one less impediment that these allocators are going to have. Now, of course, it still needs to be a good financial decision and a good investment for your type of entity. That's always been the case, and that still is the case. But now you have one less impediment to be able to make that decision in that strategy. So I think it's going to definitely open up more doors for these types of companies to invest in Bitcoin as a treasury reserve asset. And we're kind of already seeing it. It's almost like once a week we're seeing another company, like it's Rumble or MetaPlanet, or it's all these different companies kind of investing as a treasury asset now. It's almost becoming mimetic, where it's okay now. It's the Overton window shifted, whereby someone wouldn't look at you crazy if you're a treasurer or CFO at a company and you just suggested this now. So I think it's part of that whole narrative shift.
Yeah, I agree. And you spoke a lot to the external kind of thoughts there, and even internally of a corporation, right? You're coming in, you say you want to start this, and they go, well, how do you even treat it, right? And you previously had to say, well, there is no standards to account for it. Okay, now that's a box checked. Internally, your team would be pushing back of, well, I have to track every lot and impair it and create all these extra schedules. It's another step in my audit. There's all these roadblocks to, all right, yeah, maybe this isn't worth it at the time. So even internally, those are removed, which I think is big.
Awesome. Maybe I'll add one. I think, it does make a huge impact even on the public market side. I think, this, again, it's sufficiently pervasive, right? You've got both a public exchange. I know, I don't know, but I'm pretty sure other exchange businesses, some of the best money-making businesses in crypto would do public offerings in the near future. It would make sense. And you've got miners, which have been, Bitcoin miners specifically have been they're a good fit basically for public funding and public markets. And you're going to have more of that sort of market seeing Bitcoin, or returns on digital assets reflected in these financials, reflected in earnings. And I think that just continues to sort of pervade the market, right? It's more widespread, becomes yeah, I think the Overton window, like Jeremy said, shifts. And yeah, ultimately, when people can see, digital assets performing right on a financial basis for a company, whether it's producing earnings or adjusting or hedging against risks, then that makes it easier to adopt, or like see if your business is a like kind, and then think about that as a treasury strategy. So
It becomes a legitimate option for all now, right? To at least consider.
exactly. Yeah, it comes, you said it best. Yeah. But I think Bitcoin already sort of Bitcoin specifically had its sort of coming out moment as a real asset class, or real digital commodity, right? I think it's past that point of recognition, but this only bolsters it, right? It just, the more public market support, the more liquidity, the more venues, the more other capital supporting mining and other industry. It gives it incredible staying power, and this is just one more piece of it.
Yep.
Well, guys,
Yeah,
it's
great.
been another fun morning with you. I think that wraps it up. So thanks for joining us for another TNF Takes. Hope you enjoyed the insights this morning. Reach out if you've got any questions about preparing for this fair value gap update. We'll see you on the next TNF Takes.
Thanks, guys.
Thanks, guys.